Welcome to this deep dive, and man, I just have to say hello and acknowledge the absolute chaos we've seen this week. I mean, the price action in the markets has been wild.
Oh, yeah. Wild is probably an understatement. It's been a battlefield out there.
Seriously. So our sources for today's deep dive really help make sense of it all. We've got a fantastic high-level pre-market trading stream that breaks down the price anomalies we just saw, plus a really dense macro research note from 42 Macro on just how hot the U.S. economy is running right now.
Which is super important context for everything else.
Exactly.
Yes.
And on top of that, we have a pair of interviews, one with the CEO of Robinhood and one detailing some SEC insights, looking at how the actual plumbing of the stock market itself is evolving.
Yeah, that Robinhood stuff it's going to blow people's minds when we get to it.
I know, I can't wait. So the mission today for you, the listener, is we want to cut through all this noise of the recent tech drawdown. We aren't just looking at why the market fell, right? We are exposing the smart money wars that are causing these forced liquidations.
Right, because that's what's really driving the tape.
Yep. We're going to break down the exact actionable trading levels you need for the week ahead and look at how the very structure of trading is about to radically change.
It's a packed agenda for sure.
So before we even look at the charts, we have to understand why the market moved the way it did. Because this wasn't, a failure of tech fundamentals. It was actually a hidden smart money implosion.
Yeah, a massive one.
So the source details this story of Leopold and his situational awareness fund. Can you explain how this one young hedge fund manager took, $400 million and turned it into $30 billion?
Yeah, so he did it through just massive, massive leverage. He was going all in on a highly concentrated basket of AI and semiconductor stocks. We're talking huge positions in names like Nebius, MU, and SanDisk.
Wait, just those few names?
Mostly, yeah.
Yeah.
And when you have $30 billion heavily concentrated in specific mid to large cap stocks, you create this massive liquidity trap for yourself.
What do you mean by liquidity trap?
Well, he owns so much of these companies that his fund's buying pressure was artificially pumping the price up. He basically became the market for those stocks. So when sentiment shifted even a little bit, he looked around and realized, there's nobody big enough to buy my shares.
Wow. Okay, let's unpack this. It's almost like a high-stakes game of musical chairs, right? Where one player just hoarded all the chairs for himself, and then another player intentionally turned off the music.
That is exactly what happened.
Because, according to the source, the rumor on the street is that Citadel might have intentionally fueled these fears about rate hikes just to trigger margin calls on Leopold's fund.
Right. They essentially forced him to liquidate his positions so they could swoop in and buy his entire book at a massive discount.
Which is just ruthless. But I guess the fundamental question for you listening is, are these tech stocks actually bad investments now, or were everyday retail traders just collateral damage in a billionaire's margin call?
What's fascinating here is that this proves the tech sell-off was driven strictly by forced liquidation, right? It wasn't a sudden change in the intrinsic value of these companies. The businesses didn't fundamentally change overnight.
It was just mechanics.
Exactly, mechanical selling, which is exactly why we are now seeing these specific stocks attempt to aggressively recover now that the margin call selling pressure is done.
Right. But, for Citadel's alleged rate hike narrative to actually work and spook the market, the macro backdrop had to be believable, right? Like, why is capital suddenly so expensive?
Oh, the macro backdrop is terrifyingly primed for it. The 42 macro note really highlights this. The U.S. economy is running incredibly hot right now.
Yeah, the numbers in the source are pretty wild. Q2 nominal GDP accelerated to 7.9% quarter over quarter.
Which is the highest we've seen since the third quarter of 2025. And year over year, nominal GDP is up 6.5%.
That sounds great on paper, but the source pointed out that real GDP, which factors in inflation, actually slowed down to 1.5%.
Right, because it was dragged down by a massive 218 basis points from inventories and imports. So inflation is eating the growth from the inside out.
And the Fed sees this, obviously. They held rates at 3.5 to 3.75% with a 9-3 vote. But it sounds like the bond market isn't buying the Fed's narrative at all.
No, the bond market is in full rebellion. On the day of the Fed decision, we saw this historic twist steepening of 13 basis points.
A twist steepening. Okay, so that means the short end of the yield curve went down, but the long end spiked up, right?
Exactly.
Yeah.
And a 13 basis point twist is huge. It's actually tied for the fourth widest twist steepening on a Fed day in 32 years.
Wow, 32 years.
Yeah. If we connect this to the bigger picture, the bond market is financially repressing the Fed. There is a massive geopolitical supply and demand imbalance in Treasury bonds right now.
So nobody wants to hold long-term debt.
Exactly. Duration risk is the most important phrase you need to remember right now. Capital is incredibly expensive, and locking it up long-term is toxic.
And that totally explains the divergence we saw in big tech this week. It's like asking your parents for a bigger allowance when the household budget is completely maxed out, right?
Yeah, that's a perfect way to look at it.
Because Microsoft essentially said, hey, we'll just play with our old toys. They capped their new capex at $175 billion, which was actually down from $190 billion, by creatively extending the life of their existing servers to 10 years.
Wall Street loved that discipline. Microsoft's stock rocketed 17%.
But then you look at Meta, they basically asked for more cash in this terrible macro environment. They raised their capex floor to $130 billion.
And they got punished for it. Their stock tanked 9%. In a market terrified of duration risk, capital discipline is king.
So, knowing all this, the hedge fund drama, the macro squeeze, how do you actually trade this? Let's get into the actionable index levels from the trading stream source, starting with the S&P 500.
Yeah, so for the ES futures and SPY, despite all the panic, the S&P is basically just trading in a sideways channel.
Right, it's only about 3% off all-time highs. It feels like the sky is falling, but it's really not.
Not at all. The key pivot to watch is the 50% mark of this channel, which is 7460 to 7472 on the ES. For SPY, it desperately needs to hold that 739.35 to 740 level.
And if it holds 740?
If it holds, we target the highs again. But if it fails, you're looking at a drop down to the channel lows, which is this 7300 to 7330 area.
Okay, so here's where it gets really interesting for me. If the S&P is totally fine, and the source says the Russell 2000 small caps, the IWM, is actually flashing this perfect bull flag, holding perfectly above its daily 20 SMA at 287 to 288.
Yeah, IWM looks great.
Right, so why does the NASDAQ look like it's teetering on a cliff edge?
Well, this is the concept of sector rotation. Capital isn't fleeing the stock market, it's just rotating. It's leaving the over-leveraged tech names that got hit by the Leopold margin calls and is moving into broader equities.
Ah, okay.
Yeah.
That makes sense. But for the NASDAQ, the NQ futures, they are hitting major 4-hour supply and rejection zones right at 28740 to 28780.
Yeah, the NQ looks very precarious. To remain bullish, it absolutely must form a higher low at the daily 100 simple moving average. That's the 28200 to 28250 zone.
And if it loses the Monday low, which is 27939 down to 28,000.
If it loses that Monday low, then this recent rally was just a dead cat bounce and things could get ugly.
We should also briefly mention oil here, right? Because the source noted that oil pushing over 86 is a major headwind for equities.
Yeah, definitely watch CL. Higher oil means higher inflation, which means the Fed can't help the tech sector with rate cuts anytime soon.
Good point. Okay, zooming in from the broad indices, let's look at the specific charts for tech and semiconductors because the volume here has been insane.
Insane is the right word. The semiconductor ETF, SMH, is in a massive test of market structure right now.
Trying to break that lower high, lower low downtrend.
Exactly. It absolutely must hold the 532 to 536 daily low to trap the shorts. And you also want to watch DRAM, which needs to hold 48.50.
We also saw that massive squeeze on AMD over 442, but now it has to hold the 495 to 500 level. And then there's Amazon.
Amazon is such a great lesson right now. It's basically back at all-time highs.
Yeah, the source used it as a warning about dollar cost averaging, or DCA. If you wait around for the perfect dip to DCA into a great company, you might completely miss the boat.
Right. By the time you feel safe buying, the smart money has already bought it back up.
But the top watch setup from the stream wasn't even a tech stock. It was Caterpillar, ticker CAT.
Well, this is a beautiful setup.
Yeah, it had an unheard of 30% pullback to its February highs. The source says to watch for a reclaim of 850, which is the daily 100 SMA, especially heading into their August 4th earnings.
Yeah, CAT is definitely one to keep on your radar.
On the flip side, we have gold, ticker GC, which is rejecting supply at 4,200 to 4,215. And the source gave a pretty stark warning here.
We did. If gold loses 3,900, you have to look at the volume profile. There is a complete void underneath it.
Meaning there's no historical support.
Right. There are no institutional buy orders sitting there. It could mean a potential free fall straight down to 3,500.
Yikes. So what does this all mean? Like, for you listening, should you be blindly buying these breakouts, or are you just supposed to sit on your hands and wait?
You really have to preach patience here. Mechanically, it is so important to wait for a higher low to form on a chart. You want to see that confirmation of a trend shift. You never want to try and catch a falling knife, especially in a market driven by margin calls.
Let the dust settle first.
Exactly. Let the smart money show their hand.
Now, speaking of how the market actually operates, all these high-speed algorithmic liquidations and, these precise technical levels, the very infrastructure of the market is mutating to keep up with retail demand. Let's talk about the Robinhood interview.
Yeah, Robinhood is not just a basic trading app anymore. They're actively morphing into a full-blown financial super app.
It's wild. The source pointed out that their median user is now a 35-year-old married parent.
That completely shifts their demographic profile.
It really does. And they launched these Trump accounts for children, and the adoption is just massive. 7 million signups with $1.5 billion in assets flowing into them.
And they aren't stopping there. They're vertically integrating. They're actually buying their own exchange to lower their pricing.
And the craziest part to me, they got Fine&R approved to underwrite IPOs. They are going toe-to-toe with Goldman Sachs and Morgan Stanley.
It's a huge disruption to the legacy banking system.
And retail traders are getting so sophisticated on these platforms. There was this wild anecdote in the source about Robinhood's new events betting business.
Oh, the weather contracts.
Yes. Retail traders are literally buying weather contracts on Robinhood to hedge their physical flights. Like if a storm cancels your vacation, your trading account pays out to cover the loss.
That is just next-level financialization of everyday life.
It really is. And the SEC is watching all this happen while the traditional market is actually shrinking. The SEC official noted that the number of public companies has halved in the last 30 years.
Yeah, the Wilshire 5000 is realistically only the Wilshire 3500 now.
So to combat this, the SEC wants to reduce reporting burdens for companies under $2 billion to encourage them to go public. But the real kicker from that interview was that the SEC is exploring a 204/7 or at least 235 trading market.
Which is, it's a massive paradigm shift.
It's like Wall Street used to be this exclusive VIP country club, and now the SEC and Robinhood are trying to turn it into a 247 drive-through.
But this raises an important question, right? What happens to liquidity during those off hours?
That's what I was thinking.
If you have a hedge fund liquidation, like the Leopold anomaly we saw this week, and it triggers a margin call at 3 a.m. on a Sunday.
There's no one awake to buy it.
Exactly. The lack of, quote, protections could absolutely obliterate retail traders. You'd have algorithmic stop losses triggering in a completely empty order book.
That sounds like a recipe for a flash crash every weekend.
It's a huge systemic risk they have to solve before they implement it.
Man, what an incredible set of data today. Let's just summarize this journey for you really quick. We've connected the dots between a $30 billion hedge fund margin call, a macro economy that is running way too hot for the Fed to handle, and the exact actionable levels you need to watch on the S&P, NASDAQ, and semis this week.
Yeah, it all ties together into one cohesive narrative when you look at the structure.
It does. But I want to leave you with one final kind of provocative thought to chew on based on all of this. We just spent this time going over exact technical levels, moving averages, and historical volume, right?
Which is how we all find our edge.
Right. But if the SEC actually succeeds in implementing 247 stock trading, will the technical levels and moving averages we rely on today even work anymore?
Wow, that's a great question.
Like, will algorithmic night trading completely rewrite the geometry of the market? Because if the market never sleeps, you really have to ask yourself, what is your edge going to be in a 24-hour drive-through stock market?
We're definitely going to force everyone to adapt, that's for sure.
Absolutely. Well, lots to think about this week. Keep your eyes on those levels, and we will catch you on the next deep dive.